Hello, and welcome to this edition of our 2017 video Q&A series with Quilter Cheviot's Head of Charities, William Reid. In this edition, we'll be talking about diversification as an approach to income and investments for charities. Hello, William. Thanks for joining us.
Thank you.
So, how can charities go about diversifying their income streams generally?
Well, I think in terms of looking at the broader challenges charities face, is looking, I guess, at how the world has evolved in terms of traditional giving. So you've got those which obviously the rattling tins on the street corners. You've got those which have become reliant on legacy giving. You've also, I guess, within that got the challenges faced by the new fundraising regulator, and and the very many challenges that you can see that has in terms of sharing of information, not falling foul of obviously the other sort of UK government agencies now involved with that side, which is proving problematic. Alongside then looking at the investment income, which obviously traditionally for the broader sector has normally been between 8 to 10% of actually income sources, and therefore looking beyond that and going, well, other options are there. Can you set up sort of, I guess, partnerships in sense of bringing, I guess, investors or donors together who may want to support that charity, but allow them to be able to network, but also then feel that they can participate in the success of that charity.
And on investment, specifically in diversification as a risk management practice, how can charities ensure that their assets within their portfolio really are uncorrelated in the event of a market shock?
Yeah, I think for charities, whenever you're looking at your investments, again, is always to start from the position of what do these investments mean for me as a charity? Is it an endowment fund? Is this money which we hope is going to be here in 100, 200 years' time, and I want to spend the income today? Or is this a fund because I've got a particular capital project and I need to spend that money in 3 years building, the new centre to deliver the charitable objective? So I think, as ever, really the time horizon actually becomes a very key component in then looking at how you might then go about diversifying the portfolio. So again, if we're looking at the broader term, we're saying here's a portfolio where I want to spend income. You're then looking at the different, I guess, asset classes within their different attributes. But as we know, again, through 2008, actually you may think you have a diversified portfolio, but in some circumstances, pretty much everything will fall in value. So again, it's then asking yourselves within what risk parameters are you happy as trustees to operate. There's one thing to go, well, actually, let's all be in a 100% equity portfolio. But again, you could do that, but you have to accept that sometimes actually the value of that portfolio on capital terms could be down by half. That could easily and realistically happen. If you're comfortable with that, that's fine, because as well as the risk to capital, alongside that you've got, I guess, the risk to income, and it's over what time frame you're looking at that. And for most trustees, it's the impact or the risk to income over the much shorter kind of 12-month time frame is really where their risk is focused, and it's the capital risk is a more long-term, 5-year plus sort of outlook.
And one of the sort of hot button risks, I suppose, over the past 12 months has been the political and economic uncertainty across a lot of the Western developed markets, the United States, the UK and Europe. In terms of the markets you invest in and the asset classes you invest in, what can charities do to mitigate those risks to their portfolios?
Well, I think as ever, again, it's being aware of, I guess, who has, particularly on the political side of risk, who has influence, where and how might it sort of fester, as it were. So I think you've seen, particularly in the US, you've seen in Europe, to an extent in the UK, and for a long time actually in Japan, there's a government interference directly actually in, say, bond markets. So we've had, all the quantitative easing, the printing of money, and in essence governments buying back their own debt. That's been a phenomenon around for many years in Japan. Now, again, as long as the Japanese government, regardless of who's in charge, are happy to maintain that policy, that's fine. But there's not just a risk in terms of we don't like the hue of the next people coming into power and some of the legislation that might change, but there is a direct risk to your underlying investment. And that can also then feed us through if you look at things like some of the infrastructure funds. Now, we are certainly in the vanguard of infrastructure investment. I think it's attractive, but again, be aware of the jurisdiction that you're in, and also, don't see it as something that you should put all your money into, because again, we're comfortable. So when you're looking at some of the renewable contracts and the other PFI contracts, so public financial initiatives such as running the schools and hospitals in the UK, that they stand fairly well written in law. But again, a government tomorrow could stand up and rip them up and go, sorry, we're not paying you another penny. So again, political risk manifests its way in itself in many ways. At the same time, I think the other thing which has been interesting is if you look back to last year and the outcome of the EU referendum, we had about a week to 10 days of turmoil in markets. It was the end of the world, what's going to happen? And then everything sort of recovered. In terms of certainly as a domestic investor, albeit the currency, in terms of currency risk, the currency had depreciated dramatically. But then you look at the outcome of the US presidential election, and actually there was a bit of turmoil in US markets, but hours, not days. And then we had, at the end of the year, we had the Italian referendum about where that was going to lead the government there, and that all sort of didn't go the way the government anticipated, but their turmoil in markets was over in about 3 minutes. So I would say at the moment, actually, markets have become very sanguine, maybe too dangerously so, about the level of risk, and who knows what the future may bring on that front. I think when you're then looking at, I guess, on the income side, again, it's to be aware of, I guess, where governments in the past, we know going back to the days of Gordon Brown and the rate on pensions in terms of dividend tax credits, and also then the end of, the repayments and the refunds we used to get from equity dividends for charities as well, which, again, something in the history books that not everyone will remember. But again, it's then when you're looking, I guess, to the risk of your income, if you think you're going, well, actually, we're just a UK charity, we'll just have UK equities and we'll just buy the FTSE 100, so shares in the largest 100 companies listed by market capitalisation in the UK, be aware, if you look at the top 10 dividend payers in the UK market, they actually account for over 50% of all income received in the UK. You've got Shell paying sort of well over 15% of all income. So there's a risk at that end. And if you're then going, well, actually, I really want a high level of income, if you look at the sort of the top 10 payers of income in the market, in terms of their coverage, so how well covered is that dividend payment, actually none of those are what we call 2 times covered, so their earnings is less than 2 times the amount that they are paying out, and 3 of them are actually uncovered, i.e. they're not actually earning enough this year to pay it. So risks, if they say, manifest themselves everywhere. So again, being diversified by asset classes, and also, I guess, as I said, by the different types of within that asset class, the different areas that you're investing in, is really the best way to protect yourself.
Thank you, William.
Thank you.
Look out for future editions in our video Q&A series, where we'll be talking about some of the other key risks facing charities, including inflation and the cost of investment management. Thank you for watching.